Hello friends, myself Meher Tasneem, PG student of MES Asmabi College, VEMBALLUR. Today we are learning about a simple topic, that is income from house property. We all know that the income of an individual is divided into 5, that is income from salary, income from house property, income from business or profession, income from capital gains, and income from other sources. So here we are discussing about income from house property. This video includes some of the main points from the topic income from house property, that is income from house property located in foreign country, annual value, different type of rental values, determination of gross annual value GAV, computation of annual value of the let out house, composite rent, unrealized rent, taxability of recovery of unrealized rent and arrears of rent received. So let's move. Here is the first point, income from house property located in foreign country. It is computed in the same manner as the income from house property located in India. So let's move on to the points. It is taxable in the hands of only an ordinary resident in India. But if the income is received in India in the previous year, it is taxable in the hands of all assessees. Annual value, section 23. Income from house property of an assessee is computed on the basis of its annual value. So let's move on to the points. The annual value refers, first point, the amount for which the property might reasonably be expected to let from year to year. Or second point, if the property or any of part the property is let and the actual rent received or receivable by the owner in respect of such property is more than the reasonable rent as per above point. The AV will be the amount so received or receivable. Or third point, if the property or any other part of the property is let and was vacant during the whole or any part of the previous year, and owing to such vacancy the actual rent received or receivable by the owner in respect thereof is less than the reasonable rent as per point 1, the annual value will be amount so received or receivable. So we can, in simple words, we can say that annual value as per income tax, annual value is the value after deduction of municipal taxes if any paid by the owner. And we can say it is the annual value of house property which is charged to tax after allowing certain deductions. Now let us discuss about different type of rental values. There are mainly 7 types of rental values. First one, actual rent, AR. It is the amount of rent received by the owner from the tenant in relation to house property. Second one, annual rental value, ARV. It is the gross annual value. Third one, fair rent, FRV. Fair rental value refers to the rent charged on similar type of property located in the same locality. Fourth, municipal rent, MRV. It is the annual rental value of house property fixed by the municipality. Fifth, standard rent, SRV. Standard rental value refers to the rent fixed or determinable under the Rent Control Act. Sixth one, real rental value, RRV. If the owner bears the cost of common facilities like lift and pump maintenance, salary of common gardener and watchman, lighting of common stairs and corridors and water and electricity bills, such costs are to be reduced from actual rent. Such rent after deduction is termed as RRV. Seventh point, expected rental value, ERV. It is the notional rent or reasonable rent. So these are the type of rental values. For determining annual value of property, the above factors are to be taken in account. Let's move on to the next point, that is determination of gross annual value, GAV. Subpoint 1, GAV of let out house property. The cardinal principle to determine the gross annual value of house property can be expressed as given below. Expected rental value or actual rent received from the full year, whichever is higher. So let's move on to the points. First point, if the let out property is not subject to Rent Control Act, the expected rent will be FRV or MRV, whichever is higher. Second point, if the let out property is subject to Rent Control Act, the expected rental value will be FRV or MRV, whichever is higher, or SRV, whichever is less. House property is let out and it was vacant. If the house property is let out and is vacant for the full year, the gross annual value is nil. First point, if the property is let and was vacant during any part of the year and due to such vacancy, the gross annual value so calculated is to be reduced by loss due to vacancy. That is the amount of actual rent in proportion of vacancy. To find out the actual gross annual value. Second point, if the actual rent received or receivable for let out period is less than the expected rent owing to such vacancy, the actual rent received or receivable will be the gross annual value. To understand this more effectively, let us go through an example. Here is an example. Calculate gross annual value from the following information. Actual rent 24,000 per annum. Fair rent 28,000 per annum. Standard rent rupees 20,000 per annum. Solution, expected rental value is equal to FRV or MRV, whichever is higher, or SRV, whichever is less. So here we are taking FRV is equal to 28,000, SRV 20,000. So then the ERV also will be 20,000. ERV or actual rent payable, whichever is higher, 28,000 or 24,000 is higher. Without any confusion, we can say that the 24,000 is higher. So we are taking 24,000. Therefore, the annual value is equal to 24,000. That's all. Subpoint 2. Gross annual value deemed to be let out. If one is fortunate enough to own more than one house property, using all of them for self-occupation, in such a case, only one house of his choice treated as self-occupied and all other houses will be considered as deemed to let out. In case of deemed let out, the gross annual value will be A. If the let out property is not subject to Rent Control Act, MRV or FRV, whichever is higher. B. If such a property is governed by the Rent Control Act, MRV or FRV, whichever is higher, or standard rent, whichever is less. When we are taking the case of third point, that is gross annual value of self-occupied house property. In this case, the annual value is nil. The fourth point is same as the third, that is GAV of self-occupied house remaining vacant. Here the annual value is nil. Fifth point, GAV of house partly self-occupied and partly let out. Sometimes a house may partly self-occupied by the owner and partly let out in the previous year. So let's move on to the points. A. If units are inseparable, it is considered as one house and no benefit of self-occupation is allowed. And B. If units are separable, each unit or part is to be treated as separable house and the benefit thereon is provided. Sixth point, gross annual value of one house away from workplace. It can be explained with the help of an example. A person may own a house property at Kochi, which he normally uses for his residence. He is transferred to Calicut, where he does not own any house property and stays in rental accommodation. In such a case, the house property at Kochi cannot be used for self-occupation and national income therefore would normally have been chargeable, although it derives no benefit from the property. To save the taxpayer from hardship in such situation, it has been specifically provided that the annual value of such a property would be taken to be nil subject to the following condition. A. The assessee must be the owner of only one house property. B. He is not able to occupy the house property because of his employment, business, etc. away from the place where the property is situated. C. The property should not have been actually let or any benefit is derived therefrom. D. He has to reside at the place of employment in a building not belonging to him. 7 point. Co-ownership of property. In case of joint ownership of any property, when the share of each owner is definite and ascertainable, it has been provided that each of owners will be assessed individually in respect of share of income from the property. In other words, income from the property will be determined and allocated to each co-owner according to his share. Next point. When each of the co-owners of the property uses it for his residence, each of them will also get concessional treatment in respect of one self-occupied property. That's all. Let's move on to the next point. Computation of annual value of the let-out house property. Some of the following steps are required to assess the annual value of the house property. So let's move. So the steps are as follows. First point, determine gross annual value (GAV). Second point, calculate net annual value. For this purpose, deduct municipal or local tax paid from the gross annual value. To deduct municipal taxes, the following conditions are fulfilled. A. The property in let out during the whole or any part of the previous year. Such deduction is not allowed in respect of one self-occupied house property for which nil annual value is adopted. B. The municipal taxes must be borne by the landlord. If the municipal taxes or any part therefore are borne by the tenant, it will not be allowed. C. The municipal taxes must be paid during the year where the municipal taxes became due but have not been actually paid. It will not be allowed. Similarly, the year to which the taxes relate to is also immaterial. Third point, deduct unrealized rent. To make it clear, let us go through an example. Mr. Devarajan is the owner of a house which is let out at a rent of rupees 2000 per month. The municipal tax at 12% of the rent received is borne by the owner. Compute the annual value of the house. Here we need to compute the annual value of the house. So first we need to take the annual rental value, that is 2000. So it is given that is per month. So we need to multiply it with 12. So 2000 into 12, that is 24,000. And less municipal tax at 12% of rent received, that is 24,000 into 12 divided by 100. So we get 2,880. Then just minus it from the 24,000. So we get the annual value 21,112. That's all. Next topic, composite rent. Composite rent is the combined rent received by the owner of property. It includes rent of building as well as, first point, other assets like furniture, plant and machinery, etc. Second point, for different services provided in buildings such as providing lifts, security, power, backup, etc. For the purpose of tax treatment, composite rent is to be divided into A. The sum attributable to use of property is to be assessed under section 22 as income from house property. B. The sum attributable to use of services is to charge to tax under the head profits and gains of business or profession or under the head income from other sources, as the case may be. Second point, where composite rent is reserved from letting out of building and other assets like furniture and the two letting or are not separable. That means the other party does not accept letting out of building without other assets. Then the rent is taxable either as business income or income from other source, as the case may be. Third point, where composite rent is received from letting out of building and other assets and the two letting are separable, then A. Income from letting out of building is taxable under income from house property. B. Income from letting out of other assets is taxable under profit gains of business or profession or income from other sources, as the case may be. Next, unrealized rent. Certain amount of rent may not be realizable because of default of the tenant, and such irrecoverable rent may be allowed as reduction of the following condition under Rule 4 are satisfied. First point, the tenancy is bona fide. Second point, the defaulting tenant is not in occupation of any other property of the assessor. Third point, the defaulting tenant has vacated or steps have been taken to compel him to vacate the property. Next point, the assessee has taken all reasonable steps to institute legal proceedings for the recovery of the unpaid rent or satisfied the assessee officer that the legal proceedings would be useless. And next point, the annual value of the property to which the unpaid rent relates has been included in the assessed income of the previous year during which that the rent was due and tax has been duly paid on such assessed income. In short, the annual value of house can be determined as follows. First, gross annual value, then we need to less municipal tax paid by owner and the unrealized rent. So we get the annual value. That's all. Now we are moving to the last point, that is taxability of recovery of unrealized rent and arrears of rent received. Unrealized rent, section 25AA. First point, taxable in hands of the assessee whether he is the owner of that property or not. Second point, taxable as income of the previous year in which he recovers the unrealized rent. Next point, no reduction shall be allowed. Next point, unrealized rent means the rent which has been deducted from actual rent in any previous year for determining annual value. Arrears of rent, section 25B. Taxable in the hands of the assessee whether he is the owner of that property or not. Taxable as income of the year in which he receives the arrears of rent. 30% of the amount of arrears shall be allowed as deduction. Arrears of rent is in respect of rent not charged to income tax for any previous year. So these are all about the topic, the income from house property. So I think you people understand. Thank you guys. Have a wonderful day. Bye bye.